Today, I want to talk about how when Ken Griffin finally slips up, he will face jail. As a result of the failures of Silicon Valley Bank and Signature Bank, their executives likely face trial, and Ken Griffin will be no different. I also wanted to quickly touch on some crazy volume we've just seen in Bed Bath & Beyond that I think without a shadow of a doubt proves the existence of synthetic shares. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, here's a video from Congress that talks about how executives from Silicon Valley Bank and Signature Bank are solely to blame for the bank's failure, and how they will be forced to pay back their bonuses and likely stand trial as a result.
The failure of Silicon Valley Bank on the Federal Reserve's watch very clearly calls into question whether or not some of that trust was misplaced. Make no mistake, the lion's share of the blame is on incompetent bank executives. And it's outrageous that these people took bonuses and sold stock in the days leading up to the bank's failure. We should hold these executives accountable for the fullest extent of the law and claw back those bonuses and stock sales. I'm co-sponsoring a bill to do just that. But as I laid out in a letter to you, Vice Chair Barr, that, by the way, was signed by 11 other senators spanning the ideological spectrum, it's gravely concerning that retail participants, literally just regular everyday people, were able to figure out that something was wrong with Silicon Valley Bank before your regulators took appropriate action. Now, these folks don't have access to non-public information like the bank examiners do, but when people on Reddit and Twitter can spot bank mismanagement before the regulators, something is terribly wrong.
And I think that is absolutely true. When people on YouTube, Reddit and Twitter can spot bank failure before the regulators and before even the executives of those banks themselves, something is clearly significantly wrong. And therefore these executives should be held accountable to the full extent of the law and should likely face trial as a result. And we can see that it even seems that some other major bank CEOs are trying to escape before it all gets ugly. We've just seen the UBS CEO resigning, and as Wall Street Silver tweeted, he said the ship is heading for an iceberg. Are they getting out now before it gets ugly? And that's why I say when Ken Griffin finally slips up and does something wrong, he will be caught for his illegal market manipulation and will likely face trial as well and will likely go to jail. Investor Turf has posted this article saying Citadel Securities is it the shadiest hedge fund since Bernie Madoff. This article starts by talking about the loan that Citadel Securities has taken on, the equity in their business they've sold off over the last year, and how they've paid off politicians like Janet Yellen with their speaking fees. It also talks about how they effectively forced Robinhood to turn off the buy button and only escaped prosecution as a result of those significant donations that Ken Griffin has made. And it says in conclusion, it's clear that Citadel Securities and their hedge fund buddies have been up to no good. They've been manipulating the market, hiding losses, and potentially bribing politicians to keep their shady practices under wraps. Now, obviously, this is something we've known for some time, and that's why I say when Ken Griffin finally slips up and does something wrong and Congress decides they don't like him anymore, Ken Griffin will be caught, those donations will be returned, and Ken Griffin will end up in jail. And it seems the current banking crisis is getting even worse, that will likely expose more major banks and more hedge funds and more market makers, just like Citadel Securities. Santa Surfing has tweeted this article saying that Morgan Stanley and Charles Schwab are vulnerable to a bank run and they've been forced to sell off securities at a loss. Also guys, be sure to sign up to Moomoo, the sponsor of today's video, using the link in the description below. You can currently get up to a whopping 17 free shares, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools. And with Moomoo, there's also free 24/7 customer support, and you can also trade around the clock with the full extended trading hours. So it says the Charles Schwab CEO recently said the company's banking unit had enough liquidity to cover if 100% of its bank run deposits ran off without having to sell a single security, but Morgan Stanley analysts say otherwise. It says Schwab's recent performance has not been up to Morgan Stanley's expectations, with customers moving cash out of sweep accounts into money market funds at a rate twice that which the bank had been modelling for. As a result, Schwab's earnings are under more pressure than initially anticipated, and the company's facing $22 billion in unrealised losses due to rising rates. And therefore Morgan Stanley believes the bank will be forced to sell securities at a loss to fund future withdrawals. So it's really interesting that it's just another bank saying they're fine in terms of liquidity when actually they're not. These regional banks and smaller banks have been coming out and saying the bank is strong and their liquidity is fine, but usually, most of the time, solvent companies don't need to tell everyone and reassure everyone that everything's okay. It usually tends to be the insolvent companies telling people that everything is fine to try and reduce the panic so these insolvent companies can make it out without going bankrupt. As a prime example of just how bad it gets during a bank run, Peruvian Bull tweeted saying that in 24 hours, 85% of Silicon Valley Bank's deposits were withdrawn or attempted to be withdrawn. So we can see that when panic does spiral, pretty much 100% of a bank's reserves or a bank's deposits can be withdrawn overnight. And on top of that, it also seems like cash flow from Blackstone's portfolio no longer covers their debt payments. The rating agencies have downgraded Blackstone's debt as it seems the income they're receiving on their commercial property and residential property portfolios can no longer cover their rising interest costs. So again, I think we're going to see more and more bigger institutions and banks struggling to meet their debt payments. Again, this is just going to end in more unrealized losses and realized losses for these banks, for these hedge funds, and for these major institutions. Again, which is going to end in more panic, more bank runs, more banks shutting down, more executives facing trial, hopefully more executives going to jail as well. And now I also wanted to talk about how interactive brokers have finally shown their true colours. As Boss Blunt has tweeted, he said, "Goodbye, interactive brokers. They've decided to change their terms of service to allow certain cash account shares to be lent out without your permission." He said brokers clearly don't care about you if they're lending out your shares without your permission. Obviously, these brokers are doing it because these trading platforms are struggling because they're losing tons and tons of money and they're trying to figure out how to get any cash through the door. Also, considering they're working with these hedge funds, they've decided it's best to lend out your securities without your permission to get additional interest income for themselves. And again, this is just another reason as to why we're seeing AMC's cost to borrow interest rate going up higher and higher. Because these shorts are desperate for your shares, so they can try and push the price down further, hoping that more people will sell, which obviously they won't. On top of that, it seems that Wealthsimple is doing the exact same thing, as Wealthsimple now won't even let you into the platform unless you start lending out your shares. You can see this screenshot talks about turning your stocks or shares into passive income and how you can boost your portfolio's performance with no extra effort by lending out your stocks. It then shows you how it works and how you can review the agreements, but there's only one singular button for agree and continue. There's no button that says no thank you, there's no X in the corner that you can push, so you have to allow your shares to be lent out to enter the platform. Christina added saying there is some small print that you may opt out in your settings, but you can't actually enter the platform unless you agree to lend out your shares. It seems more and more platforms are getting more and more desperate when they're working with the hedgies to ensure that your shares are lent out regardless if they have your permission or not. It seems the shorts are desperate to get hold of more of your shares to try and push the price down to avoid the squeeze when the next leg down of the market crash, which is pretty much guaranteed to happen, actually happens. I also wanted to quickly touch on the crazy volume we've just seen in Bed Bath & Beyond yesterday, which I think just goes to prove even more the existence of synthetic shares. Now, Bed Bath & Beyond has a public float size of 113 million shares. That means that at any one time there's 113 million shares trading in the open market. But it's also important to remember a lot of these shares are going to be held by insiders and not traded, locked away via DRS and not traded as well, and held by massive institutions that typically don't trade their shares on a day-to-day basis. So maybe trading at any one time, you've say only got 50 or 60 million shares available to trade and available to buy and sell during the day. Now there's two parts that make the volume we've just seen absolutely crazy on Bed Bath & Beyond. The first part of that is the volume we saw yesterday alone, which is 158 million shares traded in a single day. Now, if the float is 113 million shares and only 50 or 60 million of those can actually be traded, that's around 3 times the available shares traded in a singular day. I think without a shadow of a doubt, trading over the total float and trading 3 times the available shares in one singular day just simply proves the synthetics. And on top of that, we've also seen average volume over the last month or so of 70 million shares trading hands every single day consecutively for the last 30 days. So they've not just traded over the entire flow in one singular day, but they've also been trading 3/4 of the flow every day on average for the last month. Again, I think this really does just prove there's hundreds of millions, if not billions, of Bed Bath & Beyond shares circulating out there right now due to all of those synthetics. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.